How to Manage Personal Finances book, Chapter 17, Roller Coaster Fears and Asset Allocation Models. This is Ken Boyd with the Accounting Accidentally Substack page. So an author's note, remember that I'm posting the entire text of this book on Substack and video versions on YouTube. You can email me for the details of my book's publishing date, number 5, early 24, late 24, early 25. So I don't like roller coasters. In fact, I don't like any type of amusement ride. About 10 years ago, we took our kids to our community's annual carnival and I rode the Scrambler. Dad had to go home before he was dizzy, so I'm no good at amusement rides. And in a similar way, nobody likes sharp declines in the stock market from one year to the next. In chapter 11 of the book, I use Seeking Alpha's data on the history of the stock market, a great site I highly recommend. A quote: over 88 years, the S&P 500 went up 64 years, down 24 years. The worst return was almost a 44% decline in 1931 toward the height of the Great Depression. The best return was over 50% in 1954. Now that's a roller coaster of change, but you don't have to panic. A better metric is to consider the long-term performance of the Standard & Poor's 500, the S&P 500, which I mentioned throughout the book, that index of stocks. Let's consider that historical return. Investopedia reports the average annualized return from 1928 to the end of 23 is 9.9%. The average annualized return since a total of 500 stocks were in the index, which was 1957 to the end of 23, is 10.26%. That assumes you invest all dividends, by the way. So my point is investors should look at that long-term average around 10% annually. Edward Jones has told investors for years in marketing that time in the market is more important than timing the market. Over time, the market has recovered, and that has to be true, or the average annual return would be negative and not positive. So how do we measure stock volatility? Well, beta is a measure that measures volatility in the price of an investment, and beta is a useful tool for investors to assess risk. So let's assume that you're buying IBM stock, a large company. Analysts will measure the volatility of IBM's common stock by comparing that stock's price change to the performance of an index. And if we use the S&P 500, that index is referred to as the benchmark for the beta calculation. So here's how beta works. A beta of 1 means that the IBM stock and the index move in perfect correlation, move together. If the S&P 500 goes up 7%, so does IBM stock. Betas of less than 1 mean the stock is less volatile than the index. A beta of more than 1 means that the stock is more volatile than the index. So if you prefer less fluctuation, choose a low beta stock. Investors who want to take more risk choose a high beta stock. Well, why not group investments by type than just evaluating one investment at a time? That seems complicated and time consuming. So a better way for individual investors to manage risk is an asset allocation model. And nearly every financial advisory firm offers a model investment portfolio. Many times it'll be on the website. It's an ideal blend of stock, bonds, and other investments based on your age, your risk tolerance, and your investment goals. But for this discussion, I'm just going to keep it to stocks and bonds. There's a great Forbes article that provides 3 models. So we have an income portfolio, 70 to 100% bonds. The primary goal is to generate dividends on stock, interest payments on bonds. That's why it's more heavily weighted to bonds. If the stock price increases over time on the stock portion of the portfolio, even better. A growth portfolio is heavily weighted towards stock. The primary goal is to produce capital gains by selling stock at a profit. The portfolio will also generate dividends on stocks, interest payments on bonds, but that's a secondary objective. And then finally, a balanced portfolio, as the name implies, is income and growth in some combination. So it might be 50-50 stocks and bonds. And you can ask an investment advisor which portfolio is right for you. Why time is an important factor. Keep in mind that younger people can afford to take more risk because the investor has more years to recover from stock market losses. A 25-year-old may invest a bigger percentage of the portfolio in stocks than a 60-year-old. Why is that? If stocks decline in value, the 25-year-old has more years to wait for a market recovery. 60-year-old who's retiring in 5 years has less time to make up for losses and therefore will probably take less risk, they'll probably be more in an income portfolio or buy stocks that have a lower beta. This is true whether IBM is sold at a loss or if the stock is held by an investor during a market decline. In either case, you're waiting for the market to go back up. Younger investors simply have more time. In chapter 13, I explained that Sally, our investor, is investing $315 a month into her employer's 401k plan. Sally's 35 years old and decides to use a growth portfolio with 70% in stocks and 30% in bonds. That's what we'll use going forward. So that's as far as we'll get right now. Remember that you can find all the content here on the Substack page and also on YouTube. Thanks for watching.